where we take complex research, strip away the jargon, and give you the essential knowledge you need without all the overload. Today, we are wading into some pretty scary market territory, actually. We're going to look at why one analysis is claiming that all that fear is, well, completely misplaced. We are diving deep into CRWV, ticker is CRWV if you're following along. And if you've been watching the charts, you know the price action has been just brutal.
Was the right word.
I mean, this stock has been cut almost exactly in half, dropping, violently from its highs around $187 all the way down to the $80 level.
Yeah, and seeing that much red on your screen, it's not just a financial hit, it's emotionally draining. It makes you question everything.
It really does. That kind of steep, rapid drop instantly makes the market ask, is this it? Is the whole high-flying AI story finally, collapsing?
Exactly.
But our mission today is to look at a really bullish counter-narrative. We've got an analysis that frames this massive 50% sell-off, not as a failure, but, and I'm quoting here, as the biggest gift of 2026.
It's a bold claim, a really aggressive thesis. The analysis basically argues that all this volatility has created a completely irrational discount.
So that's the central question we're tackling in this deep dive. Did the market just hand us a huge buying opportunity, what this report calls the $80 golden buy zone, or is the AI party really over?
Is the slide justified, or is it a mistake?
Okay, let's unpack this. Before we even get to the bullish reasons, we have to understand the why. Why did the stock drop so hard if the business, as this report claims, is actually solid?
And that's such a crucial distinction. The analysis really, hammers this point home. The 50% drop is not tied to any fundamental business problem.
So no lost contracts, no earnings miss, nothing like that?
Nothing. No operational failure. The problem was all external sentiment, not their internal execution.
So if the business is fine, what on earth drove the price from $187 down to $80 in, no time at all?
Two main things, according to the report. First, just simple market fear. The whole narrative around AI had shifted a little bit.
The AI overspending fear.
Exactly. Investors started getting anxious about the massive capital needed for all this AI infrastructure. And whenever that happens, high-growth companies like CRWV, they get punished first.
Okay, so that's fear. What's the second factor?
Sector rotation. And this one's a little, well, it's often a bit harder for a casual investor to really get their head around.
Right.
But it just means that big funds are pulling money out of one hot area like high-growth AI and moving it into other sectors that suddenly look like a better value, maybe energy or financials.
So the stock had gone parabolic up to $187.
It was due for a cooling off period. People were just taking profits and looking for stability somewhere else. It's as simple as that.
So a combo of fear and profit-taking. But the core business, the analysis argues, is on the exact same track.
Precisely. And that's the paradox they want you to focus on. The price changed, but the story hasn't. In fact, they make a really strong statement. The story got better.
So the challenge is to separate the short-term panic from the long-term reality.
That's the game.
Okay, that sets the stage perfectly. Let's get into the core of their bullish case. They've got three huge reasons why this sell-off is a gift. Let's start with the big one, the one that gives the most visibility. The source calls it the $55 billion backlog fortress.
It's a bit theatrical, I know. But the number behind it is staggering. CRWV is sitting on a confirmed order backlog of over $55.6 billion.
$55.6 billion. Wow. Let's be really clear for everyone listening. That's not a guess, right? It's not a marketing forecast.
No. That's signed work. These are guaranteed future revenues from actual contracts. It's the definition of stability for a company like this.
But who are these contracts with?
It's mostly large corporations and specialized AI firms who are just desperate for this kind of GPU compute power. It means their demand is locked in for years.
Like a shock absorber, then. While the market is throwing a fit, their revenue pipeline is totally secure.
Exactly. The analysis points out there isn't just demand, there's a literal waiting list. Their services are sold out.
Okay. But a deep dive requires us to ask the tough questions. A $55 billion backlog is amazing, but what about the quality of that backlog?
That's a great question. A backlog over 20 years is very different than one over 5.
Right.
The analysis implies these are multi-year contracts, which is great for visibility. The risk, of course, the one skeptics always bring up, is cancellation clauses, or, what if one of these clients goes under?
It's our counterparty risk.
It's always a factor. But the clients are mostly major, well-funded players. The analysis believes the stability from a backlog that big, well, it's just far outweighs the tiny risk of a few contracts not working out.
Okay, so reason number one, massive locked-in demand. Let's move to reason two, their execution and the focus that's driving that insane growth.
Yeah, and this is where you see a growth rate that very few public companies ever hit. We're talking about revenue growth of 134% year over year.
134%. I mean, that's That's just remarkable. For most big companies, getting even 20% growth is a huge win.
It is. They're more than doubling their size every year. That's the kind of speed you see when a company is just completely disrupting an industry.
And the analysis says this isn't an accident. It's tied to their strategy. They call CRWV the special forces of the cloud.
I love that analogy too.
Let's break that down. What makes them special forces when you have these giant armies like AWS, Google Cloud, and Azure?
It all boils down to specialization. The big guys, AWS, Azure, they're built to do everything for everybody. Web hosting, databases, storage, a little AI compute. They're like giant general-purpose supermarkets.
And CRWV is the specialty shop.
Exactly. They focus intensely on one single niche. High-performance, complex AI workloads.
And that focus must give them a huge edge in efficiency and maybe even cost for those top-tier customers.
That's the claim. The analysis says this focus lets them optimize their whole system to do AI compute faster and better than anyone else.
But we have to acknowledge the competition. The big guys have, basically infinite money.
They do.
What's to stop AWS from just deciding to crush this niche? That feels like a huge long-term risk.
It is, and that's the #1 bear case for sure. But the thinking here is that the hyperscalers are just too big, too slow to pivot their entire structure to handle this one specialized thing efficiently.
So CRWV's agility keeps them ahead.
For now, yeah. It lets them stay ahead, making them the go-to solution even for customers who also use AWS but need that peak performance for their AI models.
Okay, so we've got massive demand, we've got best-in-class execution driving triple-digit growth. Now for reason number 3. Guaranteed access to the literal building blocks of this revolution, the NVIDIA connection.
This might be the most important piece of the puzzle in today's market. You can't make money if you can't get the chips. And CRWV's relationship with NVIDIA is, well, it's critical. They are NVIDIA's preferred partner.
And in a world where GPUs are scarce, being first in line with the only major supplier is basically licensed to print money.
It is. And think about the future implications. When NVIDIA rolls out its new Blackwell chips, the next big thing, CRWV is positioned to get them first.
Which lets them build out the next wave of infrastructure faster than anyone else, just continuing their advantage.
It's a virtuous cycle.
So if the AI revolution is a gold rush, CRWV isn't just selling shovels.
They're getting the first and best shovels from the only factory in town.
Perfect analogy. But, okay, let's play devil's advocate again. The risk here is concentration, right? Their whole business relies on one supplier. NVIDIA.
It does. It's a single point of failure, and the analysis has to address that.
So what's the argument?
The analysis frames the relationship as symbiotic, not just dependent. CRWV is a key channel for NVIDIA to prove out its most advanced tech in the real world. So while it's a risk, the deep integration they have makes the relationship very sticky and mutually beneficial.
Okay, so let's connect the dots. You've got massive demand from the backlog, you've got insane execution with 134% growth, and you've got guaranteed supply from NVIDIA. The fundamental case looks incredibly strong.
It does, which makes that price chart look even crazier.
So let's shift to valuation, because at the end of the day, you're buying a stock at a certain price.
Exactly. And the report says the big change here was the shift from, speculative hype down to a grounded valuation. At $187, it was priced for perfection. Any tiny mistake would have been a disaster.
Here's where it gets really interesting. The analysis suggests all the froth has been blown off the top. So what are the actual metrics they're using to call this a bargain at $80?
They're mostly looking at the price-to-sales ratio, or PS. Right now, the company is trading at roughly 8 to 10 times sales.
Now, for a lot of people listening, that might still sound high. $10 of stock price for every $1 of revenue.
It would be high for a normal company, but context is everything here.
So why is 8x to 10x sales considered cheap in this case?
Because of that triple-digit growth. A company with 134% year-over-year growth can grow into its valuation incredibly fast. Think about it. A company growing at 10% with a 10x PS is way too expensive. But if you're growing at over 100%, that means next year at the same price, your PS ratio will be cut in half, down to maybe 4x or 5x.
So you're buying it based on next year's numbers, not today's.
Exactly. The analysis says on a forward basis, it's a bargain. It shifts the thesis from hope to just verifiable math.
And this isn't just one analysis, right? What's the general feeling on Wall Street?
That's a good point. The report cites that the average analyst price target is right around $129.
So from $80 where it closed to a target of $129. That's a calculated upside of over 60%.
It's significant. It shows that even the big institutional analysts think this correction went way too far.
Let's pivot to the charts for a second, the technical side. Does the chart itself show that buyers are actually stepping in at this $80 level?
It does, yeah. The report focused on finding a clear technical floor, a point where the selling just ran out of steam, and they spotted a really distinct double bottom pattern right around the $75 level.
Okay, for those of us who aren't chart experts, what does a double bottom tell you?
It's a classic bullish reversal pattern. Basically, the price falls, it bounces, it falls again to that exact same low point, and then starts climbing for real.
It's like the market tested that price twice.
And couldn't break it. It found a massive wall of buyers there. So that $75 mark is what they're calling the critical support, or the floor.
And did that floor hold up recently?
It did. The analysis highlights the bounce of about 4%, closing just over $80. They see this as confirmation that the smart money, institutional capital, is buying up shares in that zone, while retail investors, the weak hands, were still panic selling.
So based on the technicals, the strategy is pretty clear. If $80 holds, what are the next targets on the way up?
The report lays out the next key resistance levels. First target is $100. If it can clear that, the next big hurdle is $120. The idea is that the volatility cleaned everything out, and now the chart is set up for a measured climb back toward that analyst consensus.
Okay, so we've covered the brutal drop, the $55 billion backlog, the explosive growth, the NVIDIA advantage, and the technical buy zone. Let's bring it all together. This whole analysis really just boils down to one fundamental bet, doesn't it?
It absolutely does. So what does this all mean for you? The analysis is crystal clear. This is a bet on the AI infrastructure supercycle continuing. That deep discount is only a gift if you believe we're still in the first inning.
Right. If you think AI is a bubble about to pop, you run far away from this. But if you believe this build-out is foundational, a decade-long shift,
then the market just gave you a spectacular entry point with fundamentals that are already validated.
that's the whole thing in a nutshell.
Yeah, the report's final message is simple. Don't let a temporary red chart scare you out of what they see as a structurally green future. The backlog, the growth, all that is still real and happening.
And that leaves us where the final provocative thought for you to chew on after listening to this very, very one-sided analysis. The $55 billion backlog is real. The 134% growth is real. The question that's left is this. Will the market eventually catch up to that reality, or will short-term sentiment keep winning over strong fundamentals? That's the whole CRWV story right now.